Hi everyone, I'm James Hart from LittlefishFX.com. Thank you for joining me for this week's Forex Education Hour. In today's session, we're going to take a look at what is, in my opinion, one of the most interesting and effective aspects of technical trading, and that is the use of Fibonacci analysis. Now, although the methods used in Fibonacci analysis can be quite simple, they're actually used in strategies employed by some of the world's largest hedge funds. And for those of you who are familiar with institutional research, you'll know that Fibonacci analysis is a core component of a lot of technical analysis provided by banks. So these methods are definitely worth looking at in greater detail. And that's what we're going to discuss today. We'll talk about what exactly Fibonacci analysis is, the different tools and methods involved, and how you can use this analysis in your own trading to create profitable trading opportunities. So as ever, if you have any questions during the session, please just write them in the chat function and I'll stop periodically to answer them. And I'll just share my screen and we'll get going. Okay, as ever, I'll spare you the history lesson and we'll just jump right into the moving parts. So first of all, a quick overview just for those of you who are approaching this stuff for the first time. And for any of you who are already familiar, this will be a nice little refresher. So what we refer to as Fibonacci, the use of Fibonacci in trading, is the use of tools which identify price levels on charts based on the mathematical principles underpinning the Fibonacci ratios and number sequence, which is actually a numerical pattern that appears throughout nature, from honeycombs to seashells to flowers to astrological constellations. I mean, it's really incredibly interesting stuff. So for those of you who are keen to really dig deeper into the origins of this, it's well worth some further research because it really is fascinating. But simply put, this is what we mean when we talk about Fibonacci in trading, use of tools to identify price levels based on the Fibonacci ratios and number sequence. And there are a few key tools or methods that help us identify these levels. And these are the ones we're going to focus on in today's session. These are as follows. So first of all, we have the Fibonacci retracement. This is where we look to identify levels which could be potential turning points as price corrects within a swing. We then have the Fibonacci extension. This is where we measure a price swing to project future levels which could act as potential turning points. And then we have the Fibonacci expansion. This is where we measure a price swing and a subsequent correction to identify future price levels which could serve as turning points. So these are the core Fibonacci tools or the methods of analysis. So let's take a look at them in action and get a proper understanding of how to employ each one in our own analysis and how to use them in our trading. So we'll first of all start with the Fibonacci retracement. Okay, so in this example, you can see that we have our Fibonacci tool in place already, and it's measuring this bearish price swing. So we've simply taken our tool and applied it to the swing high in price, point A, and measured it all the way to the swing low in price, point B. So we're measuring this dominant bearish price move. And let's pretend that we're around this point in time here where we've just had this impulsive move to the downside and we've bounced a little, we're starting to move higher, and we apply our Fibonacci tool to the move, looking for potential retracement levels which could act as resistance for a potential move lower again, in line with the dominant price swing that we can see here. So firstly, some key information here. When we're measuring a bearish price move, we measure from the top to the bottom, and when we measure a bullish price move, we measure from the bottom to the top. Now, regarding the actual point that you measure from, there are some different theories about this, and I know a lot of great traders who have slightly different methods, but for the sake of building a solid foundation, the best starting advice is to measure in absolute, so to measure from the very top of a move to the very bottom and vice versa. Okay, so we have our Fibonacci retracement in place, and you can see what I mean when I say the retracement measures a swing in price to identify levels for potential reversal. So the idea is that we see a move in price, which gives us our swing, in this case, this impulsive bearish move here. We then measure the move to get our retracement levels, and we anticipate that price will correct higher within this swing and find resistance at one of these levels before reversing lower again in line with the dominant swing. And you can see in this example that that is exactly what happened. So you can see that we got an initial bearish reaction at the 50% retracement. We hit that and came off a bit. We came back down below the 38.2% retracement. We then actually popped higher again, testing the 61.8% retracement before ultimately we found resistance there, which turned price lower in line with that initial move. So this is a perfect example of how we're looking to use the Fibonacci retracement. It's very simple and straightforward. We're just measuring a swing in price, in this case, a bearish swing, and identifying levels which could cap the correction and see price turn lower. You can see we got an initial reaction at the 50%, and our final reaction was found at the 61.8% retracement. So you can see these levels in action here. You can see price reacting to them. So why is it that these levels work? Well, some people argue that the core mathematical principles behind the Fibonacci numbers and their relation to natural geometrical structure is what causes these levels to be so effective. And some people argue that their efficacy is really due more to the crowd mentality and the fact that so many traders watch these levels and anticipate a reaction, that they've got sort of a self-fulfilling prophecy. So which is it? Well, the answer is probably a bit of both, but to be honest, we don't really need to know precisely why these levels work, just that they do, and then we need to find a good way to use them in our own trading. So this brings me to the next important point. How do we know which levels work? How do we know where to place our trade? Now, the levels that are drawn onto the chart, these come as standard on NinjaTrader as part of the default Fibonacci settings. And you may see some people using additional levels or some slightly different levels, but these are the standard Fibonacci levels that you'll be looking at using this tool on NinjaTrader. We have the 23.6% retracement, the 38.2% retracement, the 50% retracement, the 61.8% retracement, and 76.4% retracement. So these are the key levels to monitor. However, we're still faced with the question of which levels will yield the reversal. And the answer is that we don't know, okay? Fibonacci tools give us the levels to monitor, but then it's up to us to make our own trading decisions. So in terms of looking to trade retracements, really what we want to identify is a confluence of factors. So obviously, depending on how you trade, this will include different things. But for myself, the areas that I tend to focus on are structural levels, price action, and trend lines in conjunction with Fibonacci analysis. So I'm looking for at least two of these factors to coincide at a Fibonacci level for me to get involved. And generally, I prefer to look mainly at the 38.2%, 50%, and 61.8% retracement, and 76.4 as well. I find these to be more consistent, and I'd only really be looking at the lower Fibonacci level where we get confluence with a different Fibonacci level from a different swing, but we'll come on to that a bit later. Okay, so looking at this example, we can see, again, assuming we're at this point in time where we've just had our initial bearish move and we've fibbed our swing, we've now got our retracement levels and we're watching price move higher. We can see that we get an initial slight reaction at the 23.6 and the 38.2% retracement. And actually both of these levels have a nice price action signal. They've got a bearish pin bar, which is a favorite entry mechanism of mine. But in terms of me taking this trade, there is no clear structural resistance at these levels. So the only thing I've got is a price action signal at a Fibonacci level. And some people will be happy to trade just based on this, but I'm looking for added confirmation. So it's not until we move up into the 50% retracement that we actually have some added confluence with a clear structural level. So this previous low is broken. So this previous support is broken, now turns to resistance. For those of you that checked out the support and resistance webinar last week, you'll know why this is, due to the underlying order flow dynamic at these levels. So we trade up, we test the 50% retracement, we have this clear structural resistance, and we also get a bearish pin bar. So this is a nice signal here, and you can see that we get a little move lower, we pop down by over 100 pips or so before we trade higher again and test further up into this resistance zone. We hit the 61.8, and then that's where we sell off from. So this is an example of where I would be identifying confluence, a clear structural level in line with a key Fibonacci level and a price action signal to boot. So this is a nice signal to use as an example. Now, if you're an indicator trader, you can look to use indicator confirmation, such as for this example, we could see a bearish stochastic crossover coming off overbought levels, or a turn lower in the MACD. Again, the Fibonacci tool identifies the levels that we are monitoring, but then it's up to us to use our own methods to establish an actual entry. But what is undeniable is just how effective these levels can be, and they are time and time again. The amount of key turning points in the markets that occur from Fibonacci levels. Now, a point that we touched on a few minutes ago, and another way that you can look to identify stronger levels and the ones that we should be monitoring for potential trades, is through identifying actual Fibonacci confluence. So this is where we look for the Fibonacci levels of different price swings to coincide, highlighting key areas for us to watch, and this can be particularly powerful. So instead of looking for a fib level to line up with structural confluence, to have structural confluence rather lining up with a clear structural level like we've seen here, what we're actually looking for is a fib level to simply line up with another fib level from the measurement of a different swing. So let's take a look at this and I'll explain it further. Okay, so looking at this example, let's say that we're at this point in time here, okay? We've traded up off the lows, we've made our initial high, we've retraced, we found this low, traded higher again, and we've come back down, okay? So price is selling off within a broadly bullish move, and we might be looking for potential locations to get long. So to start with, we fib the most recent swing in price. So that's this low to this high, okay? Again, assuming that we're around this point in time, selling off from this high. So we fib from the low to the high to give us our retracement levels to monitor. So we now have our first fib in place and we have our key levels to watch. And now what we want to do is identify confluence coming from another Fibonacci level. So remember, we always want to look to fib from significant swing points. So the next key swing point is this level down here. However, where a swing point is so close to the absolute low in this example, the absolute high in a price series, I always use the absolute low just to be sure. So in this case, I don't fib from this swing point here, I fib from here. So if we apply our Fibonacci retracement from this low to this high, you can see then that we get our new fibs in place. And you can see that the 50% retracement from the very low to highs lines up perfectly with the 61.8% retracement of this move. And this gives us really solid confluence and gives us a specific area to watch for a potential reversal. So again, we look to use our other factors to actually trade, such as price action confirmation or an indicator signal. But in terms of using Fibonacci to identify potential reversal levels, well, you can see how powerful Fibonacci confluence can be. These two Fibonacci levels lined up perfectly, price traded right down into them, touched them, and then reversed and took off higher. Now, if price had broken down through this level here, where we got the confluence of the 50% and 61.8% retracement levels, price had broken down through this level, then the next area that we would have been watching, the next area showing strong confluence, would have been this zone here, where we had the confluence of the 76.4% retracement of this move and the 61.8% retracement of this overall move. So this would have been the next area that I would have been looking at. Now, you'll notice actually looking at this lower area that the levels aren't lined up exactly as they were above, in terms of the levels here sat right on top of each other, whereas the levels here have got a small gap between each other. Now, where they're very close like this, there is still confluence, okay? Obviously, we would like the levels to be as close together as possible. Where they're sitting right on top of each other like this, that is particularly strong confluence. But so long as they are very close like this and there's only a small gap, then we still have confluence. The wider the gap is, the weaker the confluence is. So up here, for example, where we have confluence between the 38.2 and the 50% retracement level, it's actually a much weaker confluence because you can see the gap is much larger. And so instead of looking at a specific level, we're looking at more of a broad potential reversal zone. So when you're fibbing price swings and looking for confluence, always look for levels which line up as close to exactly as possible. And this is a really great way to identify potential trade locations and reversal points. So these are the initial ways and the most common ways in which we can use Fibonacci in our trading to help us identify retracement levels within a price swing so that we can gain entry to a potential resumption of the direction of the initial move. So you can see how this can be a really great way to gain entry to trending markets, where we get an initial impulsive move and a retracement back, offering us a potential entry before we get a resumption of that initial move. So this is a really great way to gain entry to trending markets on any time frame, simply looking for retracements of the dominant price move into key fib levels and looking for them to line up with structural levels, as we saw initially, or as we saw here, where there is confluence between different Fibonacci levels. And again, using elements such as price action or indicator signals to then get in and join the market as the trend resumes. And you'll find this quite a lot, that in trending markets, retracement points tend to end at key Fibonacci levels. So these can be really great areas to focus on, especially, as I say, where they line up with structural resistance or moving average resistance, etc., where we get further confirmation. These can be really great areas to initiate trades. So we'll now move on and look at the Fibonacci extension method. Are there any questions just before we move on to the next part? Okay, great. Well, as I say, please just write any questions you have in the chat function, and I'll stop as I go along to answer them. So the next main Fibonacci method is the Fibonacci extension. Now, with the Fibonacci extension, we measure a swing in the same way as we do when we're looking for retracement levels, but instead of identifying levels within the swing, which we expect price to retrace to, we actually project future levels that price has yet to reach in the direction of the swing. So let's look at an example of this to make it clearer. Okay, so in this example, point A to point B, we can see price is selling off. And let's say that we're looking for a potential buying zone, assuming that we're at this point in time here where we sold off, we've made a shallow retracement, a short retracement rather, and now we're turning lower again. So we apply our retracement tool to this leg, but we have some extra levels added in now. And these extra levels aren't within the swing. They're actually projections outside of the swing. So we apply a Fibonacci tool from point A to point B, and this gives us our new Fibonacci levels. So you can see here that we have extension levels which are outside of the initial move. So our retracement levels are inside the swing, and our extension levels come outside of the swing. And the key areas, the key levels rather, that you want to focus on when using extension tool are the 127% extension and the 161.8% extension. So these levels tend to be very powerful. So ignoring the retracement levels and focusing on the extension levels, you can see that price actually reversed really nicely from the 161.8% extension of this move. And actually, we had a small reversal here, which came just shy of the 127 extension. But the proper reversal came here lower from the 161.8% extension of this initial move. So this is how you use an extension tool. So when we get an initial move in price, you apply the retracement tool with these added levels, with these extra levels added in rather, and then as price moves down into these levels, we monitor for potential reversal signals. So using a Fibonacci extension tool can be another great way to identify potential reversal zones. And again, we look to incorporate other factors to establish confluence to trade the level, such as structural levels, price action, indicator signals, etc. Now, another way that we can actually use extension levels is not as areas to trade, but as targets for a trade that we're already in. So whenever we enter from a retracement level, we can use a corresponding Fibonacci extension level as a take profit target for our trade. So let's say that after this initial sell-off, we applied our retracement tool, and let's say price traded up into the 61.8% retracement, came back through it, and we got short here as we traded up into this resistance level. So let's say that we sold from the 61.8% retracement level, and we're looking for a level to use as a target to take profit. Well, we can actually target extension levels of this move. So knowing that price has a tendency to reverse at these key levels, we can use these as levels, as key trade management levels, to either move our stops or take some risk off or take our full position off. So these can be really great levels to use as trade management levels, not just as entry points. So finally, the last Fibonacci tool that we're going to look at is the Fibonacci expansion. And this is very similar to the extension idea that we just looked at, but where the retracement and extension tools use a 2-point measurement, measuring from point A to point B, the Fibonacci expansion tool actually measures 3 points. So let's take a look at this and I'll explain. Okay, so when we want to find a Fibonacci expansion level, we want to establish a swing in price and a subsequent correction, which we then look to fib. So we look to fib the initial swing as we normally would, but then we also include the correction in the measurement. Now, the tool that we use for this on NinjaTrader is actually called the Fibonacci extension, but don't confuse it with the extension we just looked at. On MT4, for example, the tool is actually called Fibonacci expansion. But essentially, whenever we're making a 2-point Fibonacci projection of price, it's an extension. And when we're making a 3-point Fibonacci projection, it's an expansion. So assuming we are at this point in time here, we've just had a sharp move up off the lows, we've made a retracement, and now we're turning higher again. So we can use our Fibonacci expansion tool to highlight potential reversal levels or trade target levels coming up ahead. So we fib from this point here, the low of the first move, to the high. So this is our dominant swing. And we also then drag the tool down to include the correction. So we have A, B, C, 3 points in this move, which we measure with the Fibonacci expansion tool. So now we can see that we have our expansion levels projected onto the chart. So again, we measure from the low to the high, which is the initial move. We drag it down to include the correction. And then this gives us our expansion levels to focus on. Now, the Fibonacci expansion levels that we want to monitor, that we want to concentrate on, are the 100% expansion level, the 150% expansion level, and the 200% expansion level. So these levels mark a move from the correction point, which is firstly equal to the initial move, then 1.5 times the initial move, and finally double the initial move. So 200% expansion is double the initial move. And you can see, just looking at this example, how powerful and effective these levels can be. You can see that we've got a good reaction from all 3 points here. So firstly, we traded up and tested the 100% expansion level, and you can see that we sold off from there. We then traded higher and tested the 150% expansion level. And again, we saw a reaction low and we sold off. And then finally, we made a further move higher, eclipsed that 150% expansion level, traded all the way up and tested the 200% expansion level, where price was finally capped and we turned sharply lower to reverse the move. So you can see how effective these levels are. And it's quite remarkable, isn't it, to see how price respects these levels. So without the expansion tool on this chart, these reversal points would appear seemingly random and without any probable catalyst. But using the Fibonacci expansion tool, we can actually identify that these reversals occurred at key expansion levels. And it's when you start to identify such fantastic reversals occurring at such unique points like this that you would really only be aware of when using Fibonacci analysis, that it starts to get quite exciting and you can get an idea of the sort of opportunities that this type of analysis and these tools can create. Okay, so we've looked at how to use these tools individually, and now finally I want to take a look at how we can combine these tools to create really in-depth Fibonacci analysis and identify powerful potential trade locations and key inflection points. So just before we move on to the last section, are there any questions I can answer? Okay, so again, if you have any questions at any point, please just write them in the chat function and I'll stop to answer them. Okay, so moving on to the last section, let's go back to our original slide, which was the retracement example in sterling dollar. So we can see that we had our sharp sell-off initially, which gave us our dominant price swing, which we applied the Fibonacci retracement tool to. So again, let's assume that we're at this point in time here, where price is moving up. We then want to look for further confluence at any of these levels to identify the strongest candidates, the levels that we're going to look to potentially trade. So we identify good structural confluence at the 50% retracement level. And we can see that if we traded here, we would have caught a nice reaction, but not the full move before price actually reversed here and started to trade higher again. So once we get that little reaction lower, so once the retracement looks as if it's failed and price is turning lower again, but then we actually start to retrace once more. Once we see that happen, this is where we can come in and apply our Fibonacci extension tool to the market to identify confluence, to identify potential confluence. And this is a pattern that we can look out for in the markets, where we get a retracement that fails to break lower or break in line with the dominant swing, depending whether or not it's a bullish or bearish retracement. And then we start to retrace further within the move. So we can take our Fibonacci extension tool and apply it to this initial leg. So from the B to the C. So we've had the initial swing that gives us our Fibonacci retracement levels. We've had the subsequent initial correction, which has failed. And so we apply our extension tool to this swing here. And this gives us our extension levels within the swing that we can then monitor. So you can see, applying the extension tool to this move here, that the 127% extension level, which remember is one of the key levels we want to focus on, sits very closely with the 61.8% retracement of this move. So we have a key candidate here to monitor for a potential reversal. And so once we identify a reversal candle or reversal patterns at that level, we can feel confident in entering. So this is what we're talking about in terms of combining our Fibonacci analysis to give us key levels. So we're combining our analysis and identifying advanced Fibonacci confluence, not by way of coincidental Fibonacci retracement levels, but we're looking to find an extension or expansion of an internal leg, of an initial correction that then coincides with a deeper retracement level to give us added confirmation at that level. And in fact, we can even look to combine extension, expansion, and retracement levels for an even deeper and even broader Fibonacci analysis. So looking at this slide here, this is an example of extension, expansion, and retracement, all in confluence with one another, providing clear trade locations. However, I bet that chart looks frighteningly complicated. So let me pull up the actual chart used in this example, and I can walk you through how I applied Fibonacci in that instance. Okay, so if we look at this chart here, we can see that we had a really impulsive move up. This is the sterling Kiwi chart, 4-hour chart. So we had a really impulsive bullish move up. And let's assume that we're around this point in time here, where we've had our initial correction, our initial retracement of the move. We then started to turn higher once again in line with that initial move. However, we failed and started to move lower once again. And again, this is that pattern that I mentioned earlier that we can keep an eye out for, where we retrace on a move, start to turn in the initial direction once again, but then fail and start to retrace further. So where we identify this pattern, then we know that we can look to find confluence using extension and retracement levels, or extension, expansion, and retracement levels. So we're turning lower from this point here, and we want to identify potential trade locations. Well, first of all, we start with our retracement levels of that initial move. So this is the foundation of all our Fibonacci analysis, using our retracement levels. So we fib from the lows to the highs here. Okay, up to this point, but I'll drag it across so that the levels are clear. But you can see the points that I'm fibbing, the very low to the very high. If I go ahead and just change the color on these so they're clearer. Okay, so we get our initial retracement levels, and now we want to look to find extension or expansion levels which have confluence with these retracement levels. Again, assuming we're at this point in time here. So price has just failed in its retracement and is turning lower once again. So we're retracing further within the move. And so the next step is to apply an extension tool to this move here. So again, we go ahead and use our retracement tool, and we'll actually have to add in some extra levels on here because they don't come as standard on NinjaTrader. So because this move is to the downside, it's not the 127% extension, it's the minus 27% extension. Just bear with me for a second. I think I've got the wrong level. Okay, let me do it a different way. I don't know what's the settings have gone wrong here. If we go back to the slide, so you can see the extension of this leg gives us the 127% extension down here. So that gives us the 127% extension. And we can see that that lines up with the 61.8% retracement very nicely. So we have clear confluence there. So that's a level that we want to look to monitor. And then we look to our expansion tool to give us the final confluence. So the expansion tool, remember, encompasses 3 measurement points. So we go from the high to the low to the retracement point, and then you can see that the 100% expansion level of that move lines up very nicely with the 61.8% level and the 127% extension. So this gives us clear confluence here, and you can see that price moved down into this point, hit the level, and then bounced and turned higher. So although it may seem a little complicated at first, and I'm not sure how I messed up the settings on the NinjaTrader tool, but using this sort of analysis to identify to identify clear confluence is a really fantastic way that we can use our Fibonacci analysis to identify potential trade locations. And it really is just a question of following this methodical process time and time again and mapping the major moves in price to keep an eye on these levels as they arise. So that brings us to the end of the session, looking at using Fibonacci in trading. And I hope you found the session useful and enjoyable. We've covered some interesting stuff in this session, and it really does go to show just how effective technical analysis can be in helping to create key trading opportunities. So we've looked at using the various tools in isolation in very simple and straightforward ways. We've also looked at how you can start to be a bit more advanced with your analysis and actually combine various Fibonacci methods. So if you've enjoyed that session and you're interested in learning more about other areas of Forex trading, then please head to our website, where you can take a look at a whole range of free education material, as well as our indicators and Forex master course. And if you're interested in getting daily trade ideas, you can check that out too. We just closed out another 236 pips in February. We're already up 240 pips in March. So if you're interested in getting trade alerts, definitely check that out. And remember to tune in the same time next week, and I'll catch you again then. Okay, thanks a lot, everyone. Have a good day.